You also do give what I would, well, let's call it Bogle's 10 simple rules for investment success. Maybe if I could just give them to you one at a time, you could comment on each one. And the first one you just mentioned, you alluded to a minute ago when you said, or the rule is, remember reversion to the mean. Could you expand on that one? That seems to be one of your importance.
Well, that's an eternal rule. It's like the law of gravity. What goes up must go down. And in the financial markets, it really works. I have an example in the book. The point of all this, Jim, is don't buy funds on the basis of past performance because it's not going to continue, or it's only the extraordinary case when it's going to continue. So people tend to, as I mentioned earlier, put their money into these big winners, and then down it goes. They pick the high because that's when the fund looks the best. So in that part of my recommendations, recommendation 1, I've taken 8 of the best known and most successful mutual funds of the modern era, and I've charted their return year after year cumulatively against the S&P, the Standard & Poor's 500 index. And every fund looks the same, although all the time periods are different. The fund goes like this, and then it goes like this. This, over and over and over again. And you see this in the big winners of the age, and they go away, their managers leave, even the good managers might get fired, the bad ones retire. There just doesn't seem to be any permanent way to beat the stock market. It's all fads, fashions, particular time periods. You know, when, for example, growth does better than value, you want to put your money in a growth fund, and then value does better than growth. Well, these 10 funds, which I list by name in the book, and 2 of them are Vanguard funds, in fairness. This book is an attempt to be really honest, no matter how painful, and you see that same pattern over and over again. So when you say, I ought to buy this fund, I can tell you where you are on that line, right at the peak. And when the temptation is overwhelming, you put your money in and then are disappointed thereafter. But it's part of the entire financial business. If the market gets quite out of line, stock prices, for example, get quite out of line with intrinsic values, gets high like this and it goes back and reverts to intrinsic value of the stocks. Discounted future cash flow is what we call it. It doesn't have anything to do with stock prices. It has to do with corporate intrinsic values. So, and I should have a nice chart in there to show that kind of mean reversion. It's just truth of the business and how we deceive ourselves because we all think we're smarter than everybody else.
You also, or the second rule is, time is your friend, impulse is your enemy. What do you really mean by time is your friend?
Well, we have the miracle of compound interest working for us. And when you invest over 20 years, 30 years, 40 years, 50 years, for today's young people, an investment lifetime is probably 70 years. Their life expectancy today is, if you're 20, it's probably 90. So you're going to be, and then you're going to be investing, you know, after you retire, of course, and presumably that's in your 60s or 70s for some people. And
not you, but
not me. But that curve is just a sweeping curve, and it's the miracle of compounding returns, and it pays off hugely. Albert Einstein called compound interest the greatest financial miracle of all time, or something like that. So take advantage of that, and the only thing that gets you out of it, focus on the long term. Time is your friend. But if you get distracted by the ups and downs, mostly by the downs, people respond much more nervously to downs than they do ebulliently to the ups, although that happens too. But impulse is going to get you in and out of the markets. But think about this. When the market is low, it's low because people like you are really worried. And that's a good time to buy stocks, essentially. There aren't any rules for this. And if you're ebullient and feel very wealthy and want to buy stocks, that's at the high. In other words, if you're discouraged and selling at the low and aggressive in buying at the high, your money isn't going to last very long.
And I guess that's one of the problems, that you have to try to resist the impulse, because we are human, but we're also animals, and we are basically bred to run from fear. So when we see the market goes low, we want to get out, but we have to resist that. Is that correct?
Yes, correct. And if we just didn't pay any attention to these silly swings in the market, which are, I often use this quote from Shakespeare, like a tale told by an idiot, full of sound and fury, signifying nothing. That's what we're glued to our television sets to watch every day. Makes no sense.